Hello, hi, um,
Morning, Michael.
hi, thank you so much for coming. Cool. I'll just let people sign in.
Yeah,
Hi, George. It's so early for you. Thanks for coming, man.
Oh, you're welcome. My pleasure to be here.
Thank you so much, man. Real honor. Thank you.
Thank you.
Okay, I'll just let people sign in. Okay, so I wanted to talk about a few different things. I've actually got four different topics, but I'm not going to talk for too long because last several times people had a lot of questions, and I just felt that I ran out of time at the end. So I'm going to talk like for 3 or 4 minutes, really, really quickly. Um, I'll let Daniel sign in as well because I can see he's signing in. Hi, Daniel. Can you hear me? I think he quit. Did he go? Okay, doesn't matter. Um, so. Um, just before we gonna get started, so this week I run it at this time, and then next week is 2 hours later. This is hopefully to accommodate more Europeans at this schedule and Asian people, and then next week is the Americans' time schedule. So a few things that are important to mention. So um, during last week, understandably, people commented to me that they kind of felt that if I had um, a bit less hurry, if I just was more of a buy and hold investor, I would have made more money from holding Palantir all the way from 10 to 100 rather than buying at the 10, selling at the 28, sorry, 26.50, buying at 10, selling 26.50, and then skipping all that until 100 and recommending it now at 100. Um, Listen, two things. The first thing is that when I recommend a stock, I'm underwriting that for the paying subscriber. So I have that responsibility when I recommend something to say, from this point today over into the middle of 2026, do I feel comfortable recommending and underwriting that? Because my reputation, so I have to think about that. It's not just because something is going up that necessarily it's worthwhile keeping, sometimes you have to think about these kind of things. Um, but people understandably, it's quite a divisive topic. A lot of people, particularly right now, it's like every time I come on this call for the last like year, I say the same thing that it's like the strongest bull market. At some point, it has to slow down, but every time I come up, it's like it just goes and goes and goes and goes. So it's no point saying that. But the bull market kind of like a bit of mist in your eyes. I don't know if you were like had like a bonfire and that stupid, you're making the bonfire, and a bit of wind comes in your face and like all that, the smoke goes in your eyes, like all kind of confused and everything like that. And it's like that when you're in the bull market, it skews with your mind, and you think that you are being careful, but you only see after the fact whether you are or you're not being careful. And these things sound like cliches, and they sound like everyone knows it. But, I think I was talking to my wife on Friday night, and we kind of both felt that it's a bit like going to church. You go to church every Sunday for 2,000 years, and it's the same message. Don't stab your neighbor in the eye, and it's really the same here. So I am going to just reiterate what I'm going to say, and then I'm going to open it up to some Q&A. My process is a bit like that kind of Ben Graham value investing strategy. He used net nets, which is basically looking at the balance sheet and subtracting all the liabilities, and I used free cash flow. But it's the same idea. You're anchoring that to the intrinsic value of the company. And I know there's different ways of doing that. And some people love to look at price of sales, and some people like to look at earnings per share. And it doesn't matter. All this doesn't matter. You're trying to develop the feel for the intrinsic value of the company. And what's really, really important whether it's even, let's say, I like free cash flow, is thinking about the free cash flow per share, right? So in a business like Palantir, where they have a dilution factor, you have to think about, okay, if I fast forward the clock 12 months, including that dilution, what's going to be my upside opportunity? And you have to think about these kind of things. And it's much more important. And just one more thing before I kind of press on. Um, a lot of people get really, really confused, uh, and they think, oh, the share price is up a lot, therefore the rally is over. It's over, it's over, it's over. Like that, like it makes no difference where the share price came from. That doesn't matter. It matters where it's gonna go, you know? And a lot of people kind of look back at share price over the past year, and they love to build a narrative, and they build a narrative for themselves, and they pound their chest. And I'll give the example. So I recommended that we sell Samsara just now, and the stock has been good. It's been really, really good. It was up in just over 1 year and 1 month, was up 70%. And you know, it speaks to the bull market that we're in. It's actually been a drag on my performance, but this is just because of the market just been mad. But in that 1 year that I've been owning and recommending that stock, it's been gut wrenching. It's been like absolutely like days where like this stock was down 40%. And you can look back and it looks easy. You look back, but that's why you got to think, what are you anchoring your intrinsic value to? Because narratives, I always say, as an inflection investor, it's about catching a business on a cusp of a new narrative. But a narrative is a bit like going in the sea, in the sense that I don't know. I spent a lot of time close to sea when I was a kid, so I kind of think about that a lot. You kind of you kind of go into the sea, and you're trying to position yourself kind of close to the wave, and you kind of try and make sure where that first wave breaks. So you kind of try and miss out that first wave, and then you kind of position yourself for like maximum excitement, but at the same time you don't want to be don't want the wave to take you under. And it's the same here. So narratives kind of go and come in a wave. So as an inflection investor, I'm always thinking about where the narrative is going to go, but you have to think about the fact that the previous narrative can easily bubble up from time to time. And we see that with Giga Cloud technology. And I know that right at this moment, it happens to be that Teladoc is working, but for months, I come here every single Tuesday, say, oh, Teladoc, Teladoc. And people are like, yeah, Teladoc, Teladoc. And I'm like, no, like, it's like a really good company, you should invest in it. And people are like, yeah. And now it's kind of working out, and I'm like thinking about the exit, and someone was writing me, oh, is this now a good time to buy Teladoc? I'm like, dude, like you and I are playing different games here, and that's okay. And there's no hard feelings, but we're playing different games. I'm trying to buy it cheap, and you're trying to buy the expensive, hoping it will go further. That may work. That can work. And it may but you have to think about it as an odds game. When you buy, when the expectations are not quite relevant to where it's going, you have the way I think about it is like this. When you buy it, well, it doesn't matter about the share price, like whether it's Palantir or whether it's Teladoc, it doesn't matter. It matters what people's expectations are. People get very easily confused when they look at the share price. The share price of Teladoc was like down, I can't remember the number. It was down around 85% when I recommended it. And with Palantir, it was up like 500% or something like that. It doesn't matter. That doesn't matter. It matters about relative to now for 12 months. And it's not more complicated than that. So I urge you, if nothing else, to think about the fact that you have to try to remember that the money you make in the bull market doesn't count. It matters when we go down into the bear market what you keep. So it's the hard work that you put in those dark days, those dark nights when things are going to be hitting the fan. That's when the money is made, because everyone's making money is in the bull market. I say that the only idiot in a bull market is the person who didn't buy the dip, because everything's going to the moon. But it will. I know it sounds dumb to say this, but it will slow down at some point. And when it does, you need to have a portfolio that can kind of withstand those turbulences. That's why I'm trying my best to have some kind of growth and quote unquote AI opportunities like Palantir, but I also have this kind of more boring stuff like Settle, which is, I can open it up for discussion if people say, oh, I took a nosedive, it's an absolute dog, oh my God, and whatever else people want to say. But because I think that you have to have diversification in the portfolio because you need to withstand that volatility, which you don't know when it's going to come. So, okay, I've waffled for longer than I wanted to. I'm going to open it up to some questions if people want to ask now. Nobody. I'm quite surprised. It's not that,
Hey,
it's not that there's nobody on the
hey,
call.
hey, Michael, it's Lester. And I actually put this question on the chat. I mean, what's your view on scaling out of positions in the same way as you scale into positions
Yeah,
and
I saw the question.
holding on that a little bit longer?
Yeah, I saw the question and I answered it. But I'll repeat it now because it's an important question, and this comes up quite frequently. So when I buy, I have a view. It's not a very long-term view. I picked this up from a book that I can recommend if you like to read, Super Forecasting by Philip Tetlock. It's one of the, you only need like 3 or 4 books in the world in terms of investing. You don't need many books. Like everything else is just practice. But like Super Forecasting is one of the few books. You don't need many books. That and Charlie Munger's Almanac, probably 2 out of the 5 that you need. I don't try and forecast the next 5 years, but I recognize that the market is always looking out 6 months. So no point thinking about the next 6 months, and there's no point thinking out about the next 5 years. It's a sweet spot, right? I believe looking out a year is kind of a sweet spot. So when I recommend something, I have an idea, a thesis, and I'm expecting within a year for it to go to fruition. So it's much more important to optimize the pricing point. That's why I like to buy in 2 chunks. I like to buy, because the moment that I recommend it, I put down 2.5%, and then I try and buy it lower in the next 4 to 6 weeks. It really always happens that you can get it lower than when I first bought it. So it's more important to optimize the entry point. Afterwards, if the thesis is working, it's going to work out favorably. It's going to be like up 15, 20%. It doesn't matter too much about that. But if you fast forward the clock to like from the day you buy it, you fast forward the clock 12 months, the ideas that you had a year ago are now priced in. Everybody kind of knows that idea. So do you really have any new information a year later that you didn't have? Sometimes you do, like I gave the example that I was willing to underwrite intuitive machines a bit further. I kind of felt, okay, I can do a bit further out here. And like I gave the example of Palantir, sometimes you do have new information, but often, is there really new information? It's kind of difficult. I feel that it's difficult to find the circumstances when something new can come out. It can happen. So it's much more important the entry point. As the saying goes, when it's well bought, it's half sold, right? So if you buy it at a good price, it's okay. You don't need to be a hero at the end in terms of trying to squeeze out. And also, I believe it makes you quite disciplined in terms of churning out those names because you don't want kind of half-baked ideas in your portfolio. And that's what happens when you kind of keep a little bit of the position. It's kind of like a half-baked idea. It's kind of, it could kind of go out, but that's kind of what I call a buy and hope strategy. It's not a well thought through strategy. So it's much more important to try to preserve your asset, try to protect your capital. I kind of do like that, like a boxer pretty much, because I'm kind of thinking in my mind that, it comes out of nowhere and someone punches you and you have to be prepared for that. So that is the discipline that you're putting in all the time. And really, if I was to narrow it even further down, what you're trying to develop here is a strategy of consistency, 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 where you can just kind of repeat and repeat and repeat the process. The process is so simple. And the problem is when something is like in investing, investing is done by a lot of people that are very, very smart. And the problem is that they're all trying to be smarter than the other ones. And they try to overcomplicate. If the thesis is too simple, people get bored and they get distracted. And that's why I'm really disciplined in my strategy and I've repeated like 100 million times because if it sounds complicated, you might feel smart, but the best ideas in the market are the ideas that are really dumb. Okay? You want things that are really simple that people can catch on within a couple of lines. If you have to kind of overcomplicate something, it's like confusing. It's like, it could work out, it could not. Have you thought about this? You want something that's like super clean. And yeah, I'm not going to waffle on that. Yeah. Any other questions for anyone?
Michael, can I make a comment?
Yeah, please do.
Um, I think it'd be helpful to you. I mean, it's great that you take such personal touch and care to every single member, but I think it might be exhausting to you to answer the same question over and over and over. So I think there should be my suggestion, and not any way telling you what to do, but I think it'd be helpful for your time to have a kind of like a newcomer's guide or a frequently asked questions of, because you're going to hear, should I buy it now? It's up 30%. Is it okay if I do this? The same things
I do have that. I definitely have that. It's just a question that, and I feel that some people do read it, but I also feel that sometimes people want a reassurance, that is it actually okay to buy it now? Do you know what I mean? People want to be a bit reassured. So for now, I still feel quite okay to answer that question because if the shoes were reversed and I'm paying somebody for something, I want to be careful and just double check. So for now, my service is still at the level that I'm still quite happy to do that. But I do have that in the Q&A and in the FAQ. I do have absolutely that I say that, if I'm recommending something to you, like it's to buy now, it's not to buy like in 6 months' time. But I definitely have that. But I'm also, you have to remember, I'm really passionate about investing. And I love talking about stocks. So it's also a guilty pleasure for me as well that I kind of really enjoy chatting about this kind of stuff. So it's a kind of a mix, right? So I want to provide the best service that I can. If I was paying for someone else, I want that person to to be engaged and to give me that reassurance. And then I'm also really, really passionate about this. I love investing. I'm absolutely addicted. I go to sleep and I think about it. I wake up, I think about it. The weekend, I think about it. And 2025 has started off on a really strong footing. I can't see it sustaining this level. I can't. I say this every single day, but it just goes up more and more bananas. But I continue to believe that I'm becoming better as an investor. And as I look back to where I was, I used to say to myself when I looked back 6 months ago, I was nowhere near as good as investor as I am. Obviously, nowadays it kind of plateaus a little bit. I'm not growing at the speed that I was growing for a while. It's kind of, I'm becoming more mature. In the sense that I'm not really seeing those big leaps in my knowledge that I did. But even at the same time, if I look back to where I was a year ago, I think that I'm a much better investor than I was 1 year ago. So yeah, I'm not just saying that. I really feel that I'm really going to grind really hard this year. and I'm really gonna try my best. I don't care, to deliver, let's say, 50% returns if everyone else is returning 50%. That doesn't excite me. Last year was up 75, and everyone was up 100 or whatever. Like, that doesn't excite me. It excites me much more to deliver outperformance against, let's say the S&P or the Nasdaq. If those two don't deliver such great performance, that'd be much more exciting for me to, for example, deliver 25% if the S&P only delivered 10%. That would be much more exciting. Like, wow, the market wasn't that hot and I still did quite well. That'd be much more exciting to me than the market like last year was up 26% and I'm up 75. Everyone else is like killing it. It doesn't excite me. But you can't control, those are not your controllables. But what you can do is make unpopular choices, like I did today with Samsara. I'm sure people will kind of say, oh, you should have held on to it. And, you always have to think quite carefully. Is there that mist in your eyes? Because the market kind of just has this ability to confuse you. So you have to really, really careful and disciplined. And I feel like, I'm very excited because I'm predominantly a small cap investor, and the peak of my earnings will not only be next week, so it's not even this week. Whereas most of the large caps have already reported, everyone's already gone through all the information. But my businesses are only really starting to report next week, which is like the middle of February, and they go into early March. So yeah, I'm very excited to see how things unfold. There's some favorites of mine, like Asana, that I'm really kind of fingers crossed, that I'm really hoping to see if it can get to $30 a share. Sezzle is one that I feel like I have a lot to prove. So yeah, I'm very, very excited to see how things are going to develop.
Thank you.
Thanks, Michael. Lester here again. I'll jump in with another
Jump away. I don't think anyone
question.
else wants to talk, so please jump.
It's interesting. I saw your title Outperformance, not in the bull market. I don't know whether you caught the article in the Financial Times. I just pulled up so I reminded myself of the title. Why speculators are still running wild when money is no longer free. A really, really good article. I mean, it's it's on about this new sort of meme trend of buy the fucking dip, BYFD, which is now being pushed around, and it just basically talks about the bank bailouts, the liquidity that's still in the system, quantitative easing that it argues still has not worked its way out of the system at all. And the amount of money sloshing around looking for somewhere to generate a return is still alive and well in the market. So, I think I absolutely share your concern, but I really wonder when this bull market will end, if there really is all this excess cash looking around. All it will do is start going into some of the small caps, some of the companies that you can't figure out why their valuations are going so high, because people are just looking for riskier and riskier assets to get a return on.
I generally don't read anything. I read a lot of books, but generally the books that I read have been published a long time ago, and I never read anything particularly modern because I don't want to skew my mind. But what I will counter to that, I didn't read the article, but what I will counter to that, I don't know if COVID was really a dip or not, I don't really know, but at least 4 years into a very strong market, is there really that much more capital sloshing around? I don't know. I wouldn't guess so that there's a lot of capital on the side looking to go somewhere. Who hasn't bought already NVIDIA that wanted to buy NVIDIA? So I don't know. And also, as I was I'm not very good at kind of explaining myself often cases, but people build narratives on the share price. share price is going high, and people love, particularly journalists, like to say, "Oh, this is what I think. Look, this is confirmation evidence because the share price is going in that direction." The rug gets pulled out. I don't know if you remember. I don't know if you remember, but in December, this like just like 2 months ago now, like stocks did kind of take a little breather, and now it looks in hindsight, it was I can't even remember. Like it's like come and gone. But it can very quickly. Things can turn really really quickly, and when it does, which it will, you need to know like are your companies properly financed? And I think about that a lot. I spend a lot of time thinking about the balance sheet of the companies that I'm on. Like, how much more capital will they need to reach their particular milestones? So you have to not read too much into what people's opinions are. I know, and it's rich of me to say that because I sell a service where I'm asking people to read my opinion. So I recognize that. It is a cliche for me to say that, but I kind of double click on everything in terms that people say, like, what are they really trying to? What's the incentive? Is the incentive to sell you a story, or is it to deliver a fact? It kind of, those kind of things I think about a lot. It's not really, answering your question directly, but I'm always a bit skeptical. I try to be careful, basically. Yeah.
Understand. Thank you.
Michael, maybe just on that though, in terms of when you say, it's coming, is it just a matter of like you're just referring to like, yeah, bull market's coming to an end? Like,
yeah, of course.
I guess it's not like you're worrying about some macroeconomic trend or tariffs or something like that. Where you go, that's not your style. I take it.
Yeah, so it sounds hot to make bold macro calls. It sounds exciting. It sells. But I don't do that. I follow more companies myself than probably most analysts do. I don't know of many people that could tie a story up as well as I could. And I could stay here and spin a story to you, talk about DeepSeek and all this BS. But at the end of the day, it's BS because nobody knows how things are going to unfold. But you just have to think like markets do go through cycles, and it generally a cycle kind of like there's a semi-cycle every 4 years, and there's like a full business cycle every 7 years. And for a long time, it's been the same playbook of being quote unquote tech stocks to the moon. So I know it sounds like dirty to say that, particularly that I'm heavily invested in tech. But at some point, man, that kind of idea of software eating the world is going to and reverse. And I'm not going to make any type of macro call and like look into the future and stuff like that. But there has been a starvation of capital investment in other areas of the world, predominantly physical things. If you want to build, I'm not a macro person, but if you want to build all these power plants, you need to connect it up somehow. You need copper, you need a lot of cement to basically build up these towers. So all these power plants, all this AI, it needs something in the physical world to tie it up together. It's not just that you write a bit of code on DeepSeek and everyone is able to. You need the world to move forward. You can't just go down one avenue. You need a bit of connectivity. Cables, copper, cement, steel, you need all this other stuff. So I know it's out of vogue right now, and I'm not trying to make a bold call, but I do know that things change. It's slowly at first and then suddenly. So it will change. And I know that we've been on this playbook for a long time. And if I'm not actively thinking about how it's going to change, I'm not doing my job. But I'm not that type of investor. I just need to focus on the individual companies. And that's a lot easier to do. It's much easier, for example, to say, I think that Samsara is going to go to $60 because of X, Y, and Z, predominantly free cash flow, and sell it when it kind of gets close to there, rather than say, oh, I think China's going to do that because Trump said that. Sounds cool to say that, but I don't think people can actually make money from that. People can sell advice from that. That's easy to do, but it's actually much more difficult to make actual money, a return from that. Yeah. Okay, does anyone else want to ask any other question?
No, nothing from me. Just be interesting to see the earnings calls coming through with your picks.
And you know, in the past, when I started out, I actually would get really nervous about that. And when my company billed on Thursday night, didn't perform, I was like, oh God, it's like it started. Uh, but I've actually, you know, as I've kind of become more desensitized to this, that doesn't actually excite me as much. You know, even when like, you know, Centrus Energy, it was a kind of ironic actually. Centrus Energy reported results and Bill reported results, and one was down 30%, the other one was up 35%. And actually on net it was the same. The portfolio was actually unchanged. But I don't actually get that excited anymore. When the company does bad, oh well. It's yeah, it kind of, you know, you see enough of these and you kind of get a bit jaded. What is much more interesting to me is how the portfolio is doing. That's really interesting to me. I get very excited about how the portfolio continues to grow. That's very exciting. How individual companies do is not that interesting. What is important is that you're diversified, right? That's really, really what's important in terms of a lot of people like to have 5 or 6 stocks, and those are the meme stocks. And I say, spread it out a little bit. It's what I call marathon mentality. You have to have a view that you can make a fair amount of money, and it's nice to make a fair amount of money, but if you try and rush it, what I call the hero investor, you end up being the zero investor. It's those people that are trying to speed this up too much that are going to underperform in 2025. So it's much more important to position your portfolio with a little bit of a driving, let's say, in the second gear, and go at it a bit slower, but actually get to the destination rather than pedal to the metal and, you know, all in. And like a lot of people, I don't know, I don't know, a lot of people like to put like loads of options and stuff like that in the portfolio. And I'm not looking at you, George, but I did read your comment. And I just feel like, you know, it's not worth the stress. It's not worth it. It's much more exciting to, you know, to get to the destination rather than rush a process that it's difficult to rush. It's difficult. It's really, really difficult to rush. But if you try and do it consistently, you don't even need like such a long time. If you compound at 15% over 5 years, you know, you double your money. That's okay. You know, that's okay. It's in 10 years, you've really significantly, you know, moved higher the ladder. And that doesn't excite me. Well, get it. And I speak to my wife. My wife's like, it's not that people want excitement. People want quick money. And I'm like, I don't know. Like we have this argument. I don't know how much people want quick money versus how much people actually just want that dopamine effect of uh, earnings results, share price to the moon, tap 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 on my chest. I'm a hero. She says that I'm misguided. That what people want is quick money, but I don't know if people want quick money as much as they want excitement. I don't know. I don't know. But yeah, of course, you know, it's going to be a very volatile time. And the way that I say to people is, listen, you can ignore anything I'm going to do over the next few weeks. But when I put a trade alert, that you sit up, you action it, you read through it, you know, you buy or sell that stock. The rest of the time, you know, you can do other things. Because there are different types of investors. Like someone like George, you know, has a lot of time on his hands. He can go through more comments and stuff like that. And other people that may not have a full-time job or something, you know, just that one in the week where I say, you know, trade alert, buy or sell this. that is the time to do something. And the problem is that you kind of get into a situation where in earnings results, there's a lot of volatility and people are running in that direction and the other direction. And then it's difficult to go from those 3 weeks every 90 days of quote unquote action to then sitting on your hands for another 3 months. But that's the game, right? The game is that you have to, it's difficult. It is a difficult game because you have to go from a period of action to then 3 months of not having action. And it's really difficult. And how can you mentally do that? You know, it's really, really difficult to do. But I really hope that, you know, through my guidance, people can kind of be a bit more disciplined. And anyway, yeah, we'll see how it goes. Okay, I think I'll wrap it up there. Unless anyone else wants to ask any questions. Okay, thanks everyone. Really appreciate your time, and I'll see you next week. Thank you.
Thank you, Michael.
Thank you so much. Bye-bye.